Bhargava, who we promised will join us, and she is with us. Deepali, good morning. Thank you very much for joining us. Let me take the more pleasant number first, the IIP number. Should we take it as major good news, a number we have not seen in 3 years?
Hi, good morning. I think it's definitely a good number. Our expectations were 6%, and the underlying momentum, judging from the 3-month and 3-month seasonally adjusted change, remained very, very strong. It actually inched slightly higher. And if you look at the seasonally adjusted numbers, it's actually on consumer durables, it's the highest number in 9 months. So I think consumer durables is really the positive surprise there. And since we've been waiting for this lag transmission of positive income effects following lower fuel prices and also the monetary policy transmission, and more of that is yet to come, I think it's good news because it does seem like it's more of a stable pickup rather than a random pickup.
Okay, and you know, this has also come at a time when clearly global demand was shrinking. So should we therefore take this number as even more positive? It must be domestic demand.
Yes, absolutely. I think export growth momentum has been dilly-dallying quite a bit. We were quite looking for an export recovery for quite some time. But given the correction in global growth forecasts that we've seen for 2016 in the last couple of months, I think it's unlikely that export recovery is going to hold. And it does seem like it's very domestic driven. I really wanted to highlight this a number which is coming out very strongly for the last couple of readings, which is the gems and jewelry production, which has been growing at over 150% for the last 3 months. And this could be in anticipation of a festive demand picking up in 4Q. And a lot of people got worried about a pickup in gold imports as well during June to August. So it does seem like both of these indicators are in a way related. So you could see a little bit of moderation in consumer durables as because this is really the restocking which is probably having. But other indicators like passenger cars, etc. as well tend to indicate that positive income effect factor is playing out in a bigger way by the urban consumer.
Okay, Deepali, hi, morning. So you spoke about consumer durables within the manufacturing growth, but capital goods as well has seen a very sharp up move. I mean, almost 22%. What's the trend looking like? You think that's an aberration, or do you think this trend could continue?
Hi, morning. Capital goods, I think, has been the very, very steady source of growth for IIP in a very long time. I mean, it used to be the most volatile, and now it's the most steady component. So, again, if you look at the momentum indicator, it remained very, very strong. There was a marginal correction on a seasonally adjusted basis, but then overall it's not so bad. We continue to think that capital goods production is gradually reviving, and it's really led by public investment. And there are a few indicators, I mean, there are a few reasons why we think that the sequential momentum could be positive. One is improved cement production. So although we've seen a reasonable pickup in road orders that have already happened, but I think the real pickup in cement production is likely once the monsoon season is over. So you should see that impact coming in from September, October onwards, and gradually I think electricity production should improve as well with some clarity on how SEBs are going to sort out their debt problem.
Oh yes, there is that, of course. But give us your comments on the inflation number as well. The food inflation number has come in lower than what many of us feared, but services inflation, which seemed to be dipping, actually moved up about 30 basis points.
Yes, absolutely. And I think when we talk about the supply side constraints and how that's really driving the inflation momentum in India, this is really this part of the economy that we refer to. So I think the supply side constraints are pretty much evident there. And in a recovering economy where demand is expected to go up, you can only see demand for health and education go higher. Both of these numbers at 5.5% and 6% respectively on inflation are higher than RBI's target of 5%. And I think from here on, this will really be the key number to watch out for if food prices stay broadly under control.
Oh yes, that's all looking very good. So very quickly, any cuts this year, and how many cuts in calendar 2016?
We think RBI's projections for Jan to March are still on the higher side. We are definitely lower than 5.8%. But that's not going to call for any rate cuts this year. We think the front loading of rate cuts has already happened. But beyond this financial year, I think given a weaker transmission of lower input prices to output prices and the risk of higher services inflation, we think incremental reduction in inflation may be difficult to come by. In 2016, there could be a window to cut rates, but I think that will really depend on how global growth evolves. But from the domestic inflation point of view, I think we're pretty much done with the rate cuts.
All right, Deepali, thanks so much for that. So that's the word coming in on all of the macro data. That piece has fallen together very well for us. So not just is IIP improving, the growth piece, but even food CPI, I mean, ex pulses and vegetables, it's cooled off to sub 4%. So that's not a bad thing.
No, that's certainly supply management. After two bad kharifs, if you are able to keep, what cereal prices are 1.8% inflation. I mean, that's definitely a very big achievement in terms of food management and global prices at
some mismatch, Lata, because all the news in national media has been the pulses prices, the dal prices.
Pulses is different. Pulses is 30% higher. Cereals is lower. I completely take your point. Pulses, there is still a lot of work left to be done. Unfortunately, India is the only importing country. Once you go into the market and say you are pulse deficient, even the global prices shoot up because nobody else is importing. I mean, nobody else is, producing so much of pulses. A little bit from Turkey and Myanmar is all we have. So pulses is actually difficult to control even if you keep your doors open. But that's a smaller point. It is a big item in food inflation, but it is the only item which is misbehaving. Onions have been controlled very well. So I would still give the government marks for inflation. But services, as Deepali pointed out, you have to worry, that education and health and all are not getting any cheaper. Every passing tick, it is 5% higher, 6% higher. So that inherent inflation remains. Anyway, the point is for the moment, the market is going to celebrate growth. 6.4% is a good number.
Okay, I feel Anuja's pain because whenever you go into the market, you're paying higher for the dal than the other pulses.
Triple digits.